What is conventional financing? How much can you afford with conventional financing? What are the credit score requirements? How much down payment do you need? Well, that's exactly what we're going to discuss in today's video, along with many other commonly asked questions around conventional financing as we discuss the conventional loan requirements for 2024. What is conventional financing? Conventional financing is essentially a loan that's not secured by the federal government. Loans like FHA, VA loans, USDA loans, these are all loans that are backed by the federal government, whereas conventional financing is not. And with that, conventional loans can be made up of conforming loans, those that meet certain guidelines that are set out by Fannie Mae and Freddie Mac, and non-conforming loans, those loans that don't essentially meet those requirements, but also fall under the category of conventional loans. But something to keep in mind, not only are conventional loans different in the fact that they're not backed by the federal government, they also have different requirements when it comes to down payment, when it comes to credit score, in addition to max loan amounts, as well as how they calculate your debt to income ratio in order to determine how much home you can actually afford to purchase. And we're gonna go over all of that in today's video, but before we do that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up, and also subscribe to the channel to not only support the work that I do here, but to stay updated on everything mortgage and real estate related. Now, back in the day when people thought of buying a home, they were usually thinking of conventional financing because a lot of people believed that you needed this large down payment to buy a home, somewhere around 20%, that you could not buy a home putting any less money down. And that's simply not true. In fact, there are several loan programs out there that allow you to put as little as $0 down, but more commonly loan programs out there that require somewhere between 3 and 3.5% down payment. And that's exactly what conventional loans require. Conventional loans require a minimal down payment of 3%. Now, if you're familiar with FHA loans, this is actually a little bit less money down than an FHA loan, but that doesn't necessarily mean it's a better loan than FHA, which we'll talk a little bit about in today's video as we're going over some of these differences. Now, a moment ago, I mentioned that a lot of people are familiar with conventional loans with the idea of putting 20% down. And we just debunked that myth by saying that you only need 3% down. But with that, you're going to have mortgage insurance when you buy that home. Now, a lot of people believed, hey, I have to put 20% down so that I can avoid that mortgage insurance, or I should not purchase. And the reality is you don't need to avoid mortgage insurance in many cases out there when you're buying a home. It's really the cost of doing business. And if you're not in a position to put at least 20% down, you're going to have mortgage insurance on whatever type of loan program you do, whether it's conventional financing and or FHA financing. But with that being said, you're going to have mortgage insurance on your loan when you put less than 20% down and you're using conventional financing. Now, you might be talking to a lender out there that says, hey, we can do a conventional loan and you're not going to pay any mortgage insurance. Understand, you're paying that mortgage insurance, whether it's a separate fee that shows up every single month on your mortgage statement, and or it's built into the interest rate that you're getting from that lender. So what lenders can do, instead of saying, hey, today's interest rate is 6%, which may be the best in the market for a conventional loan, they might say, hey, the interest rate today is 6.25%, which means as a borrower, you're paying a little bit higher interest rate than you would be normally, and you're actually subsidizing that monthly mortgage insurance that you would have otherwise. So just be careful when you're out there talking to a lender who's telling you there's absolutely no mortgage insurance. Ask questions to make sure and understand how you're actually paying that fee. Now, one of the big differences with conventional loans when it comes to mortgage insurance versus a loan like FHA is that, for one, you don't have an upfront mortgage insurance premium like you do with FHA. So you're only paying a monthly fee. You're not paying anything upfront when you get that loan. Now, with VA loans and FHA loans, you have an upfront mortgage insurance premium. And with FHA, you also have a monthly. Now, VA doesn't have that, but conventional requires this monthly fee. And one of the big differences with conventional financing is how this monthly mortgage insurance premium is actually calculated. In fact, there can be a number of factors that affect how much you pay monthly, from your credit score to how much money you're putting down to how many borrowers are on the loan. All of those different things can affect how much you actually pay per month when it comes to mortgage insurance. Now, earlier in the video, I mentioned that you can get a conventional loan with as little as 3% down. Now, the problem with conventional financing and only putting 3% down is the monthly mortgage insurance is likely going to be a lot higher than it would be if you were doing FHA financing. Now, FHA financing, you have a basic fee that you pay per month, regardless of your credit score, if you're putting 3.5% down. So if you're putting 3.5% down and you're using an FHA loan, the mortgage insurance is the same, regardless of those factors that I mentioned earlier. Whereas conventional financing, all of those different factors affect your monthly premium, which means you're likely going to be paying a lot more on conventional financing per month when it comes to mortgage insurance than you would be with FHA. But one of the advantages is you're putting a little bit less money down. You're putting 0.5% less down towards the down payment, and you also don't have the 1.75% upfront mortgage insurance premium that you have with FHA loans, which in theory means you have a little bit more equity in that property at the time of your closing. Now, you have to decide whether or not that's the right loan for you, and we're going to talk about that in today's video when going through that pre-approval process, what you need to do in order to make sure you're getting the best loan for you and not getting taken advantage of. But before we do that, I want to talk about some of the other loan requirements when it comes to conventional financing. So earlier in the video, I said, what credit score do you need in order to get conventional financing? Well, conventional financing has a minimum credit score requirement of 620, which means that you need to have at least a 620 in order to get conventional financing. But understand, if you're somebody out there and you're looking to put the minimal down payment of 3% down, you're not going to get approved with a 620 credit score. In fact, in order to get that 620 approved with conventional financing, you're going to need to be putting a larger down payment. These are just some of the basic requirements. You need to meet all of their requirements and be the perfect candidate in many cases in order to get that 620 credit score. In fact, in the environment that we're in right now, you need somewhere closer to a 640 in order to get approved for conventional financing. Now, that doesn't mean you can't get it done with a 620. It just means it's going to be more difficult. In fact, the lower your credit scores, the more difficult it's going to be to qualify for a loan, especially when it comes to putting a minimal down payment. Now, if you're the perfect candidate out there, you have 780 credit scores, you're putting 25% down, conventional financing is going to be the best financing out there for you, no question. But I realize a lot of people watching this video aren't going to be perfect candidates. They're going to have a hiccup here or there that may prevent them from getting the absolute best terms in the market. And therefore, I want to make sure we're going over all these scenarios so that you fully understand it. So with that, just because you have a 620 credit score and you have a down payment doesn't mean you're going to qualify for a conventional loan. These are the basic requirements that we're talking about here, right? You still have to go through the pre-approval process. You still have to go through the underwriting process to make sure that you meet all the other requirements. With the next one being a debt to income ratio requirement of less than 36%. At least that's what they put online. Now, that's simply not true. You don't need to have a 36% or less debt to income ratio in order to qualify for a conventional loan. In fact, assuming you have good credit, you're putting, a decent down payment down, you can get as high as a 50% when it comes to the debt to income ratio. Now, if you're watching this going, I don't understand what debt to income ratio is, what are you talking about? Well, a lender uses your debt to income ratio to determine how much home you can afford. So when you ask how much home can I afford, what they do is they look at your income versus how much debt you have, and they are looking for a certain ratio in order to figure out how much home you can afford. So let's say, for example, you make $120,000 a year. We're doing this number because it's easy to calculate. Let's say that's the gross monthly income before any taxes come out, because that's the number they're going to use. Now, I realize you pay taxes and you might put money into a 401k. You might even have some garnishments that come out of your check of people that you have to pay. Well, the lender's still using your gross monthly income. And the reason for that is because people have different exemptions. They have different things coming out of their check. So in order to keep it all equal, they use the gross monthly income. So in the case of $120,000, that breaks down to $10,000 a month, because we take the 120, we divide it by 12. There's 12 months in the year. We get $10,000 per month. So now we have your gross monthly income. Well, what they do is they divide your debts into that gross monthly income. Now, when it comes to your debt to income ratio, there's something called a front end ratio and a back end ratio. Your front end ratio is your housing expenses. This is the principal, interest, taxes, and insurance, any HOAs, any other fees that might be associated with that property, not utilities, none of that stuff, but, anything associated with that proposed payment. So if you're buying, say, a home and the mortgage payment, just the mortgage payment alone, not property taxes, is say $3,000 a month. And let's say the property taxes are $500 a month. So we know that your principal and interest is $3,000. taxes are $500, so we know that's $3,500. And let's say you have insurance of $100 a month. Well, that's $3,600, right? So what they do is they take that number and they divide it into your gross monthly income, into that $10,000. So we know your front end ratio is 36%, right? But we're looking at the back end ratio. The back end ratio is the most important when it comes to conventional financing. And depending on your credit score, depending on your down payment, will determine how high you can go. But you really want to stay under 45% in most cases in order to meet their basic loan requirements, which means if we have $3,600 housing expenses on the front, we can't have more than, say, $900 or so in monthly debt that shows up on our credit report in order to qualify for this home. Because when we look at the back end ratio is your housing expenses plus those debts that show up on your credit report, and they divide that into your gross monthly income. Now you're probably asking, well, what shows up on my credit report? Well, it's things like car payments, credit cards, student loans, any sort of revolving and installment debt shows up on your credit report typically. Anything where you had to apply in order to get credit shows up. Now, it doesn't show your utilities, it doesn't show your cell phone bill, it doesn't show how much you pay in groceries or childcare or how much you spend on date night. That's for you to figure out. That's for you to budget to determine how much you can afford. The lender isn't looking at those numbers. All they're doing is saying, what debt show up on your credit report? They add that to the proposed housing expenses of the house that you're buying, and then they divide that number to your gross monthly income. So let's say, for example, you got a $500 car payment, you have student loans of $100 per month, and you got credit card bills that are $100 per month. Well, we know our proposed housing expense in this case was $3,600. We've got $700 in monthly debt, so we add those two together, that's $4,300. We divide that into our gross monthly income of $10,000, so we know we have a back-end ratio in this case of 43%. So depending on whether or not you meet the other qualifications that conventional financing requires, there's a really good chance you're probably going to get qualified for this loan because at least you meet the debt-to-income ratio requirement piece of the puzzle. Now with that, there's something really important to understand. Your mortgage payment, that $3,600 payment that I was mentioning earlier, well, take away the taxes and the insurance that I used, that principal and interest, that payment is largely impacted by the interest rate that you receive. Now, conventional financing has competitive interest rates out there depending on who you're looking at. Now, something to keep in mind. If you talk to 5 different lenders, you might get 5 different quotes when it comes to interest rate. And the reason for that is because lenders get paid different ways. Some lenders charge upfront fees, like points, origination points. They charge processing fees. They charge other things to you as the borrower, and they give you the absolute best interest rate out there in the market. Whereas other lenders might not give you the best interest rate in the market, but they might not be charging you any fees at all. So you have to determine which lender you want to go with. Which route do you want to go? Do you want to pay a little bit more money and have a better interest rate, or do you want to pay less money and maybe have a slightly lower interest rate? But what I will say is when you're having this conversation with a lender, they're going to require documents from you. And that's one of the questions that I want to talk about in today's video. What documents are required when going through the pre-approval process? Because when you're trying to determine how much home you can afford, you can't simply call a lender online and say, hey, this is my credit score, this is how much income I make, and get an accurate quote when it comes to your interest rate. You need to provide documentation to that lender so that you can actually get pre-approved. There's a difference between pre-approval and a pre-qualification. A pre-qual is simply calling somebody online and giving them some information without providing any documentation. That's okay in some cases for an initial call, but that's not okay if you're thinking of going out there and looking at homes or writing an offer on a home. You need to go through the full pre-approval process to make sure there are no issues with your credit, with your income, with anything that you need to work on in order to be able to buy a home, if you will. So they're going to require that you fill out a loan application. They're going to require that you provide your pay stubs, your W-2s. If you're self-employed, you're going to have to provide your full tax return. You're going to have to provide checking and savings accounts, 401ks, IRAs, that sort of thing to provide assets, provide documentation on where your down payments come from. And once they have this, they're also going to look at your credit, right? They're going to run your credit in order to determine what your monthly debts are. And then they're going to use the calculation that we did earlier and figure out how much home you can afford based on all those factors. With that said, your credit score is going to largely impact what interest rate you get. If you have fantastic credit scores, 780, 800 credit scores, you're likely going to get the best interest rates in the market. And if you have lower credit scores, maybe below 740, maybe even below 700, 680, if you will, well, chances are you're going to get hit with a little bit higher rate. In fact, your mortgage insurance per month is also going to be higher because you have lower credit scores. So if there's something I can stress in this video, is work on your credit more so than your down payment. Your credit affects your monthly payment more than anything else. Yes, your down payment matters and you should work on that, but you need to work on having good credit. I hear a lot of people all the time say, I have the basic requirement to get conventional financing. I have a 620, I want to buy a home. Okay, you can, maybe, if you meet the other qualifications, but it's in your best interest rather to work on your credit so that you improve the situation overall, because not only will you get a better interest rate, you'll get a lower monthly payment, and in turn, you'll be able to qualify for more home. So work on your credit first. So with that, I can't stress how important it is to make sure you're working with a professional, somebody that understands the business. Please don't go on Google and just search lender want to buy a home and then go with the guy that shows up. Those people are paying to be there, right? Go with somebody that you trust, somebody that you know, somebody that you like. If you have a referral from somebody that you know, like, and trust, go with it. If you don't, I actually created a referral link below of people that I know, like, and trust, that I know personally, that will guide you through that process. There's no fee. And it's simply a conversation to determine how much home you can afford based off what we just talked about here. Now, something they'll also do, which you should do as a potential lender, is compare loans. Maybe you don't know whether conventional financing is the best loan for you. Maybe you were thinking about FHA, but conventional sounds good. Well, have the lender run both side by side when going through that process so that you can determine, which loan's best for you, which has the lowest monthly payment. What are the upsides and downsides to choosing each loan, which is right for you. That's what you have to determine, and the only way to know that is a habit comparison. So make sure whichever lender you go with, you're getting the lender to compare loans to show you options and then ultimately let you decide which loan is right for you. So on top of the down payment requirement, credit score requirements, debt to income ratio requirements, there's also some requirements when it comes to buying a home, and that's that you must have steady income and employment. Now, I realize people have gaps in employment, they change jobs, they change careers. All of that is okay most of the time. Now, in some cases, it can be an issue. Typically, what you want is 2 years in the same line of work, which means if you've been working, as a mechanic for 2 years and you change jobs and you go to work at a mechanic at a different company, that's okay. Even if you're in the automotive business, if you're a mechanic here and you're something in the service industry for an automobile company, that's probably okay too. But what you don't want to be is a mechanic here and then go become a loan officer or a real estate agent and go from a W-2 employee to a 1099 employee and not have 2 years history of doing that. That's what you don't want to do. You don't want these major changes in career choices in most cases. In fact, you can come out of college in some cases and use your college as part of your 2-year history in order to qualify for a home, as long as you get a job pertaining to what your degree was. So if you have questions around this, a lot of people have questions about income and employment and how it works. I would stress to make sure you're talking to a professional, run your scenario by them and let them help you. I do these videos and people listen to them and then they just run with the information and think, hey, I meet all those requirements, I'm good to go. Don't do that. This is a video for educational, for novelty purposes, just to give you an idea, right? A bird's eye view, if you will. Make sure you're talking to a professional when you're going through the process and dotting the I's, crossing the T's, just to make sure there's no issues out there when you're actually ready to buy a home. And some of the biggest issues can arise when it comes to that income and employment. So just make sure you're providing that documentation, you're giving a full story so that the lender knows exactly what's going on and can factor that into the decision-making process when it comes to whether or not you're going to qualify. Now, one nice thing about conventional financing is that you can buy not only a primary home, but you can buy a secondary home and or an investment property. But keep in mind, as you move from a primary home to a secondary or an investment property, it's going to require more money down and typically higher credit score. So it's not the same loan requirements for a primary home as it is an investment home. There's going to be additional requirements when it comes to buying that home. Now, if you buy a home as a primary home with a minimal down payment using conventional financing, there's nothing to say at some point in the future, maybe a year out, you turn that property into a rental property and then buy your next primary home. That's absolutely doable and possible, assuming that you qualify for that loan. So that's always an option. In fact, you can also do that with an FHA loan. But the biggest difference between FHA and conventional financing when it comes to buying units is that FHA still requires just 3.5% down when you're buying 2, 3, or 4 units. Whereas when you're buying units with Conventional financing, you're going to be required to have more money down in order to qualify for that loan. So just something to think about there when you're talking about buying units and what type of loan you want to do. Another question to run by your lender. But keep in mind, there are loan requirements when it comes to FHA loans. Depending on where you're located in the country will dictate how much the loan amount maxes are. If you're in what's considered a high cost area, you're going to have higher loan limit requirements or opportunities, if you will, when it comes to buying a home. See, here in Orange County, the conventional loan limit is $766,550. But there's a high balance limit because we're a high cost area that allows you to purchase up to $1,149,825 using a conventional loan, as long as you meet all the other requirements. Now, if you're buying a 2-unit, 3-unit, or 4-unit, the loan limit requirements go up from there. In fact, we'll put them here on the screen so that you can see exactly what they are. But if you're wondering where the loan limits are in your particular area, I put a link in the description below where you can go type in the address so that you can see exactly what the loan limits are in the area that you're looking to purchase. So those are really the basic requirements when it comes to conventional loans, but I want to touch on some commonly asked questions. We're going to do a kind of a rapid fire here to give you some really quick answers. And the first one is, how much home can you afford with conventional financing? Now that goes back to earlier in the video. It all depends on your debt to income ratio. So depending on how much debt you have and how much income you make is going to determine how much home you can actually afford to purchase. That's one of the things that the lender is going to do when going through that pre-approval process. The second question is, are there any income limits? No, there's no max amount on income that you can make in order to qualify for a conventional loan. In fact, there's no minimum either. You just have to have a debt to income ratio under the requirement that conventional loans have in order to qualify for a loan, which takes me into, can you have a co-borrower? Can you have a co-signer on the loan? And the answer is absolutely, you can have a co-signer on the loan. You can also get a gift of funds to help you with the down payment. These are things that conventional loans require. But even with that said, you still have to qualify for the loan, even if there's a co-signer on it. You have to factor in their income and their debts as well and still meet the requirements. Just because you have somebody helping out doesn't mean you automatically qualify. You still have to meet all the requirements, including your credit score has to meet it. Even if the other borrowers that are co-signing have perfect credit, you still have to meet the minimal requirements in order to get approved for a conventional loan. Another question that comes up, what types of properties are eligible? And the answer is really any. You can buy single family homes, you can buy condos, you can buy townhomes, and you can buy units as well. But keep in mind with units, as we mentioned earlier, it's going to require a higher down payment when it comes to financing. And one of the other questions that come up, what is the loan duration? Well, it all depends on the type of loan that you go with, but most people traditionally go with a 30-year fix. But one nice thing about conventional financing, depending on the lender that you go with, is you can really get any duration that you want. If you wanted a 28-year loan, you could get it. But typically they go in 15, 20, 25, 30 years, but really you can do any loan amount you want up to 30 years, depending on the lender that you choose to go with. Now I realize there's probably some additional questions that you have about conventional financing, even about, the process. How does mortgage process work? What happens when I get pre-approved? Where do I go next? Well, I actually created a first-time home buyer course to guide you through this process and really walk you through everything from getting the mortgage in more detail than we talked about here today to finding an agent, writing an offer, how to negotiate, what you do once your offer gets accepted, everything that you need to know. So if you're interested in learning more, becoming an expert in the home buying process, remember, this is the most expensive purchase that you'll ever make in your life. So making sure you do it right from the start is very, very important. So if that speaks to you at all and you want to become that expert, do me a favor and check that link in the description below. Now, something I want to stress in today's video is maybe you don't meet the requirements for conventional financing and thinking, hey, there's no way I can buy a house. I don't have this large down payment. My credit scores are a little bit lower than you mentioned. Is there any room for me? Yes, there are other loan programs out there. This is not your only option. In fact, there are other options out there that might be a better option for you with more lenient guidelines, a little bit more flexible guidelines. But what I would say is one of the first steps you really need to do once you determine you want to buy a home is make sure you're talking to a lender. It's never too early to have that conversation, just in case there's things you need to work on and get prepared in order to buy. So if that's you, just make sure you do it sooner than later so that you're not, putting yourself in a bad position if and when you're ready to pull the trigger and then you're having to work on things. But if you want additional information about conventional financing and believe it's the right program for you, but you just want a little bit more information, well, do me a favor and check out this video here.